Hey, good morning, everyone. Marty Missouri here, April 27th, 2022, with a quick market snapshot for you. In the morning note, I said I'd circle back with the video and take a look at some potential downside targets if this corrective action continues to play itself out. So I'll do that on the longer term charts. Let's start first on the 60-minute chart. And as I look at this, it just reminds me that indeed technicals matter, right? Looking at the charts, looking at resistance, support levels, and so on. The reason I say that is because look where the market bottomed so far today, right here on this support line that goes back into March, actually all the way back to February of this year. To look at the kind of the psychology of this, if you will, from a fear of missing out standpoint, traders are looking at this and they're seeing a bottom here. They're seeing a bottom here, they're seeing a bottom here, and they anticipate, maybe they're feeling this themselves, but they anticipate that others who may have missed these opportunities see the market right there again, and then say, no, I'm not missing that opportunity. I'm going to buy this because, I see maybe some swing trading opportunities, right? I buy it here, I sell it here, and so on. And, we'll see. And then what happens is, you break below these levels and then smart traders will have stop losses and the stop losses hit and they sell and you move down to another level. So, interesting again this morning that we found support right on that line. Should have been anticipated if anybody's trading this thing short term. Let's take a look at our all-important momentum indicators, and they would actually support that as well. So we have on the MACD, see we have a lower low here, but we have a higher low, and we have a little buy signal here on the hourly chart. On the RSI, this means we were oversold. That's why it's green there. And we also have kind of a bullish divergence, I guess. Actually, oh no, we definitely do. Yeah, so we have a divergent low there, and it diverges with this. So yeah, you could say if you wanted to try really hard, I guess you could kind of make a wedge in there. Thing is, though, you could also make a serious bear flag pattern right here, right? Let me clean that up and do it again. You could make a serious, again, bear flag pattern right here. That looks pretty classic. So if that were to play itself out, you'd have a price target, the length of the flagpole, which would take us down to about here. So folks, and what have we seen today, right? This is the hourly chart. We see just a lot of chop. We were up like 1% on the S&P, then down like, 1/3%, then back up. The VIX has kind of been all over the place. The volatility index, which measures the price of implied volatility in options contracts, though, north of 30 is a dangerous place relative to price action when you see the VIX that high. So don't hold your breath here, folks. This is not the action that you tend to see during bull markets. Let's take a look at the daily chart and get more pertinent for our purposes here. Let's first look at just the price chart itself. Recall we have this bear flag pattern in here, which was classic, boy, for sure. That's just almost textbook. And then you get a price target, and sure enough, we drew this line right where this would fall. And ironically, when I zoom out a little bit, let's go to a 2-year chart. It gets us right back here to what was resistance all the way back, April, May of last year, so about a year ago. Absolutely should be some support, although it's busted through that yesterday, and that's where it's finding resistance today. So when we zoom out and look at the daily chart, suddenly what was support is starting to look like resistance. So we'll see. Market's going to bump its head up there on there for a while. Now, if it gives up the ghost here, right, and it keeps threatening to, but I don't know, right? It seems to want to rally as well. Certainly a lot of dip buying. So if indeed it does, give up the ghost, what are we looking at in terms of levels? So I have a support line right here. You could argue maybe a little bit here, but I think you'd have to argue that case. That looks pretty weak. This looks a little more substantial. It was, it was pretty good resistance there for 2 or 3 months. So if we take a look at what we're looking at there in terms of potential downside, where we start to get to something meaningful, as I said on the morning note, well, nobody likes a 12% decline in the S&P, and by the way, it's 20% for the NASDAQ. that's just, historically speaking, that's not anything really. So another 6.8% would get us down to about 3950 on the S&P. I would say that if we go down and hit that you'd get some probably some nice, support right there and probably a rally. Below that, you lose that. There's really nothing to keep you below about 3,700. Now we're talking about 12%. Add it to where we already are, and you're down about 25% on the year. I think that begins to get the Fed's attention. I don't have a line right here at 3,500, but I should. So right around 3,500 right there. Yeah, 3,550 or so would be another area of support. So folks, yeah, technically speaking, there's another 15%, 20, and then we get down here to the 2020 support that we have back here in August, and then we're looking at a 35% decline. Ironically, that's what we experienced in 3 weeks when the COVID lockdowns hit the U.S. back in 2020. I don't know that this is how it's going to play out. Resolution to what's going on in Europe, the Fed suddenly, getting dovish, raising a 1/4 point versus a 1/2 point next week. That would send the market higher in a big way. They're not suggesting at all that they're going to do anything other than a 50 basis point increase. Now, if they sound dovish, because I think 50 basis points is priced in, so it's going to be what they say beyond that. Lots of people are making, really hard predictions in both directions. We don't want to do that. We want to hedge our bets in here, which we're doing actively, clients, as you can tell. So we want to mitigate something very, very big. We want to be in a position to take advantage of that if and when it happens. And we want to be in things that make sense longer term, based on what we think is a pretty clear structural setup for things like commodities, foreign equities and things, over the next several years. But we want to do our job in the meantime, pay attention to some of the short-term developments, and just be in a position not to get too pummeled when we have something major to the downside. And we think conditions are such that we could see that. As I've said multiple times lately, our base case is that this market explores lower levels, maybe significantly lower, before 2022 plays itself out. So our pattern on the weekly chart, I've done this several times, so we don't need to go back and look at the history, but when we have a pattern that looks like this. So we did have this bear flag, and that almost played itself out, but what we have is a 50-week moving average. That's this green line right here. Historically, over the last 2-3 decades, when we've come down and busted that and then failed a test or two, with virtually no exceptions, when the pattern begins to really give up here and this line begins to flatten out, we end up with at least a test of the 200-week moving average, which from the bottom of this body of that candle right there is another 17%. So call it a 30% decline in the S&P. And these are the areas where I think the Fed starts taking notice, and also is areas where I think people begin to kind of freak out over this. Maybe this alone does a real number on demand and therefore quells some of this rising inflation. And then the Fed can begin having a more dovish conversation and back away from some of its tightening threats. If that's the case, then of course this would be a good support area for the market. And then last but not least, the monthly chart. This is the one, given our analysis, that when you have this sell signal here on the monthly MACD, the monthly moving average convergence divergence, with just one exception back here in 1998, which was still a 20% decline, and that was just barely a sell signal. When you get it, right, when you get the sell signal, here we are way up here above ground getting a sell signal. When you've gotten that historically, right, at a minimum, you've come down and you've tested the 50-month moving average, which is another 18% from here. So call it a 30% decline. So folks, what the charts are threatening, right, what probabilities are leaning toward technically by our analysis. I'm sure there's other technicians that would look at these charts and see different things, but by our analysis, there's potential for a meaningful decline here in this market. So as managers of other people's money, we're going to hedge actively in a way to try to mitigate as much of that as possible without leaving the market altogether. And as I said earlier, be in a position to exploit these opportunities when they present themselves. Oh, let me show you one more thing, then I'll let you go. This is what bear market action looks like from a volume standpoint. Okay, so this is the on balance volume indicator here. So what this does, I've shown you this before, and it's anything but perfect, as all of these things are. But what it does is it accumulates the volume each day, and when you have a down day, the line moves down by the total volume of the S&P 500 that day. When you have an up day, the line moves up by the total volume that day as well. So when you're declining here, and notice we started declining while the market was hitting all-time highs, what that says is that there's much more volume, see this, on the down days than there is on the up days, suggesting that there's more conviction on the part of sellers, right? They're coming in mass and selling this market, right? So you see the big down dip there and just a little bit of volume on the up day, and you're still just meandering your way lower. Why is this so imperfect? Well, because you have days like yesterday where we were up a bunch early and then down, and then we look internally, and was the volume, during the day, was the volume when everybody was buying or when everybody was selling, and so on and so forth. So you look at that. But long term, those things kind of average themselves out, and this becomes a meaningful picture. And what this suggests is distribution, that the rallies are happening, and I'm using air quotes, the smart money is selling into those rallies or fading those rallies, and that makes sense to us right here, and this confirms that that's what's going on. So folks, interesting stuff. I hope you can tell in my voice there is absolutely zero panic on our part. I've done this for 37 years, so we've seen lots of market dynamics. We do think that it's different this time in a sense that structurally we're dealing with global populism, deglobalization, other factors that we think lead to structural inflation going forward. So we're going to have to rethink kind of how we make money in the market going forward. We think there is substantially greater opportunity in other parts of the world other than just the US for a whole host of reasons, not the least of being just sheer valuations and just a real history, at least of the present bull market, and I take the present one all the way back to 2009, of utterly dramatic outperformance on the part of the US market versus the rest of the world. So we have cheaper valuations and we have huge potential for reversion. Anyway, long story short, from an overall macro perspective, we do the best we can on understanding the overall setup, if you will, across regions, asset classes, etc., and do the well-calculated right things from a risk-reward standpoint. And of course, we will have volatility, including downside volatility. That is unavoidable if we're going to make money in the long run. So folks, a little longer again than I typically have been doing of late, but I think I needed to do this today given all the volatility. Hope you have a wonderful rest of your day and rest of your week, and look for tomorrow morning's Morning Note. Thanks as always for watching and listening. Take care. Bye-bye.